Next topic is 2.5, investment in equity securities. When we say investment in equity security, it means an ownership interest in an entity. That ownership interest could either be in the form of common stock, which you call the ordinary stock. It could be in the form of preferred stock, right? Or it could be in the form of warrants and call options. Preferred stock and common stock we have already discussed in our unit 1. Warrants and call options, they are derivatives and they will be discussed in your section B CMA part 2. All these common stock, preferred stock, warrants, call options, all they are collectively called equity securities. So these are the areas covered within equity investment. And remember, the type of investment that is explicitly excluded from it is convertible debt. Convertible debt securities are those bonds which are convertible into known numbers of shares in the future. So convertible bonds are not equity securities. There are 4 types of equity securities: common stock, preferred stock, any warrants or call options that give the holder the right to convert those warrants or options into common stock. Okay, so we make the idea. How do we treat the investment in equity securities? The investment in equity securities depends upon the percentage of ownership. If you have investment between 0 to 20%, it means your presumed influence is little or none. So this is the way we use fair value measurement. That's the topic for today. If your investment is between 20 to 50%, it means you exercise significant influence. When you exercise significant influence, then the accounting method, the options available is equity method or the fair value through OCI, fair value through other comprehensive income, or other word it's called fair value option. We will discuss this in detail today. Equity method is a separate topic discussed in 2.6 already. And then if your investment is between 50 to 100%, it means you exercise control. Holding more than 50% stock in any company means you exercise control. In this case, the accounting treatment is consolidation. That will be discussed in 2.9. So this is 2.5. This is 2.6. 2.7 is a separate topic called investment in debt securities, and then 2.8 is consolidation. We'll discuss as we proceed. Okay, makes sense. Now we are right at this point where our investment is between 0 to 20%. Okay, so how do we measure investments in equity securities? The method that is allowed under the US GAAP is that investment in equity securities are measured at fair value if your holding is between 20% to 0 to 20%. The method we use is called the fair value method. And under the fair value method, what we do, we remeasure the investment to fair value at each balance sheet date and any subsequent reporting date. Any gain on a remeasurement, any loss, it is reported as a part of income statement. We'll discuss it in detail. So this gain or loss is called unrealized holding gain or loss. Let us try to understand with the help of an example. On November 1st, year 1, AB company purchased 200,000 shares, 200 shares of Gale company, common stock, 200 shares of Gale company at fair value. The investment is less than 1% of the ownership interest in Gale. Less than 1% means you are falling somewhere between this range, 0 to 20%. So having 1% holding means you exercise little influence. The following are the fair values per share of Gale company stock at the relevant dates. At the date of acquisition, the fair value is $100. It means the purchase price is 200 shares at 100 each. The initial investment would be booked at 100 multiplied by 200, $20,000. We will debit we will debit our investment in equity securities as $20,000 and we credit the cash. Of course, we would have paid through cash. Okay, now let's see what happens in the subsequent period and let us fill in the blank as well. So we have this investment that we made on 1st of November year 1 and the value at the date when we purchased 200 stock, it was $20,000. So that's the value on our balance sheet, right? What about income statement? No gain or loss in income statement. Okay, what happens? At the end of the year, just after 2 months, these shares fall in value. The fair value is now $90. So these shares now stand at $200. 200 shares and multiply by 90. Now the value is $1,800. What we have to do, we have to bring these investments from $20,000 on the balance sheet to $18,000. Resultantly, when we bring these investments down, by crediting the investment, the debit is charged to the income statement as the unrealized loss. Why is it unrealized? Because the price have just changed. We haven't actually sold the investments. It's just that they have fallen in value from 100 to 90, right? So this is called unrealized holding loss. $2,000 is a loss. Investments now are $18,000 because they have fallen by $2,000. How do we book in our books of accounts? We debit unrealized holding loss $2,000 and investments in equity securities credited by $2,000 because investments have fallen by $2,000 and this $2,000 loss is recognized on the income statement. All right, next, what happens? We held on to these securities for the whole year, and at the end of the year 2, 31st of December, the share price has gone up to 115, thereby giving you the total value of investment 200 shares at the rate of 115 each. Now the value of the shares has gone up to $23,000 from $18,000 to $23,000. Definitely there is a gain of $5,000. This unrealized gain, why is it unrealized? Because investments have not yet been sold. This unrealized gain of $5,000 would be reported in income statement and investment would be increased by $5,000. So the entry that we will pass is debit the investment in equity securities by $5,000. From 18 plus 5, the investment would be $23,000 and the $5,000 increase in the value of investment is called the unrealized gain. Now it makes perfect sense. This is the initial record keeping of the investments. When the price fell, there was a loss of $2,000, unrealized loss. And when the investment gained in value over the period by $5,000, we had an unrealized holding gain. So all these are unrealized because investments have not actually been sold, right? So this is how we report. Every year, we compare the book value with the fair value. If the fair values have fallen, there is a loss. If the fair value, as on the balance sheet date, has gone up, it's a gain. And mind it, these are unrealized holding gains and losses because we haven't yet sold the investments. That's how we treat our investment if the holding is between 1%, 0 to 20%. In this case, it was 1%. Now, this is something new that has been added in your 2.5. What about measurement of alternative for investments in equity securities without a readily determinable fair value? What this is all about. So far, what we have seen, these investments that we made in Gale Company, 200 shares, they had a readily determinable value. On the date of acquisition, the price was $100. On the balance sheet date, the price fell to $90. That's the market value. And when we reached 31st of December year 2, the market price rose to 115. All these are determinable fair values that can be observed from the market. What if we hold certain equity investment? What equity investment? We have 4 types of equity investments. Either they could be common stock, they could be preferred stock, there could be warrants that are convertible to common stock, or there could be the stock options. They are all equity. So we have a very nice numbers on the stock market that we can use as a determinable value. Preferred stock may have a market value, but what about the warrants and options? They do not have the value in the market. They do not have the readily determinable fair value. What do we do? They are asset, no doubt. We have purchased them. So what do we do? How do we value them? So valuing such equity investments that do not have any readily determinable value, fair value, that's the next agenda. So measuring alternative for investments, that is options, warrants, or sometimes preferred stock, without any readily determinable fair value. What would we do with them? So as I said, an entity may elect a measurement alternative for investment in equity securities without readily determinable fair value. When we say these investments, we mean preferred stock, which may not have any determinable fair value, options, and warrants. How do we value them? We have been given this formula by the standards, the US GAAP. The value of investment is the initial cost. Let's say the initial cost of investment was $10,000. That's what I paid to purchase the warrants or the options. This $10,000 was the initial investment, initial cost. What is impairment? We'll discuss it a little while later in the later slides. Plus minus any price changes. Now the issue is these options, these warrants, they do not have any determinable value. How do we determine the price changes? How do we determine? Let's say I have options, X options for example, and I do not have their prices because there is no determinable market value. And these options have been issued by ABC Incorporated. Alright, I have 100 options and I do not have the idea what's the price is. ABC Incorporated also has certain options similar to these as X, and these options are called option Y, for example. Right? Now these options, if they are priced at $2 and these options are similar to the options I am holding, it means I can value these at $2 as well. Right? So I can use these option valuation, Y options, as a benchmark. So any changes in these options reflect the changes that I must incorporate in my investments, in my options, in my warrants. Right? So value of investment is what you originally paid. Minus impairment, this is a separate topic we'll discuss later. Plus minus any price changes. If the price changed for the option Y, I must change it as well. Right? So value of investment for those investments, warrants and options which do not have readily determinable fair value. For these we use this formula: cost minus any impairment plus any changes in some suitable measurement that is priced almost in the same way as your instrument or your investment. Right? That's what we do. So it must be applied until, so we have to apply this method, this one, cost minus any impairment, we'll discuss later, any price changes of some equitable, some similar investments of warrants and options. You must continue to use this method until when? Until you have a readily determinable fair value. The above method, as I said, must be applied until the investment has a readily determinable fair value. So that's more or less a necessity. Until you have a determinable market value, you will be using this method. Right? Makes sense? And as I said, we must assess the value of investment at each reporting date. Mostly it's the end of the fiscal year, 31st of December, or whichever accounting year a company is using. So this assessment must be made at the end of each reporting period. Right? And it says if the fair value of an equity investment is readily determinable, we will stop using this method and we will start treating it in the same way as we have treated these investments in Gale Incorporated. What did we do in the previous one? We simply debited the initial investment. When the market value fell, we considered it as a loss. When the market value rose, we took it as a gain, because we had an objective market value, determinable market value. That's what it says here. Once for these equity investment there is a readily determinable fair value, the investment is measured at the fair value through income statement exactly in the same way as we have treated our investment in Gale Incorporated, those 200 shares that we bought at a certain price, and then the value, we bought it $100 each, then the market value fell to 90, and then it rose to 115. So we'll treat these options, these warrants, in the same way as we have treated these 200 shares with Gale Incorporated, right? That's the point to be remembered. Now, what is the impairment test? What is impairment test? Let us discuss this. Impairment test. We got the idea. We will have our initial cost of the investment in equity instruments like options and warrants. We will have some suitable benchmark. How do we determine impairment? That's the next topic. Impairment test. An impairment test must be performed at each reporting date. There are two steps in impairment test. First step is called the qualitative test. And then is the quantitative, that is the dollar based. First is the qualitative test, then is called the quantitative test. What's the difference? Qualitative test assessment means just an assessment, just an evaluation whether an investment has been impaired. Certain event will tell you, like if the company's financial performance is deteriorating, earning per share is falling, company has recently undergone into a loan default, or there might have been a downgrade in credit ratings. So there will be some indication, some trigger that will tell you that the investment has impaired. So first is the qualitative assessment or qualitative test. It's just an assessment that certain event will indicate that the investment has fallen in value, like deterioration in earnings, deterioration in credit ratings, reduction in the assets value, overall assets. That is an indication that our investment has fallen. That's the first step. If it indicates that overall qualitative assessment is telling us that there has been an impairment, now we go for the actual computations. It's called qualitative test. It's called quantitative test. We will involve certain numbers with it. How we do it, let me explain first. So first is the qualitative test. Investment is impaired if the fair value of investment is lower than its carrying value. That's like, for example, if we are carrying investment for $12,000, that's the carrying value, sometimes also called the book value. But its fair value, as you just go and sell it in the market, it just fetches you $9,000, or that is what it has been priced in an arm's length transaction. Two people are ready to buy and sell at this price. So this is the value in the books, and this is the value in the market, which means we were carrying it at a higher price, whereas these should have been valued at $9,000. The difference between these $3,000 is the impairment. So what is impairment? It's the difference between the carrying value and the fair value. And it is calculated after the first step, qualitative assessment. That is just an assessment that certain indication of reduction in value because of deterioration in earnings, a downgrade in credit rating, etc. Right? So as I said, qualitative assessment, it's an assessment that seeks to determine something has happened that has resulted in decrease in the value. Discussed a little while earlier. And qualitative assessment is done using this. You compare the carrying amount with the fair value. The difference between these two is called the impairment loss. Now we have the idea how to report these. Initial cost was $12,000. Impairment loss $2,000. We just calculated. And any price changes, let's say 700 plus or minus, and it will indicate that your investment now stands at $9,300. You have to consider this $2,700 as a loss in your income statement, right? So when you have investments in equity that have readily determinable fair value, it is very simple, like the case previously. You simply can take these values and either consider it as a loss and a gain. But in case when there is no readily determinable fair value. That's the process you must adopt in order to determine the gain and loss. Right? As it said, impairment test must be performed at each reporting date. It's two-step process. First is the qualitative assessment, and then is the quantitative assessment that I just shown you a little while earlier. Right? Now, observable price changes. I gave you an example like you hold X options in a company ABC Incorporated, and that company also has certain options Y that are valued and they are similar, X and Y are similar. So I can take these as benchmark. Right? So observable price changes mean any price change in these options would be taken as price changes in X. Right? And as I said, we just try to find out any reasonable benchmark. We should put a reasonable effort to identify relevant transactions that have been issued by the same company, ABC Incorporated. Right? We don't have to, like for example, we are talking about the year from 1st of January to 31st of December. We don't have to track the prices of Y throughout the year. No. We don't have to track the changes in the price of Y options throughout the year. Just on the balance sheet date or just a few days before that. Right? Just before the balance sheet date or on the balance sheet date, we don't need to track the price changes around the whole year. No. Just a few days before the balance sheet date. Let me write a few days before the balance sheet date or on balance sheet date. That will represent the price against which we will compare the price of our X investments. Right? We just need to make reasonable effort. Right? Observable price changes. We don't need to make exhaustive efforts, extensive effort to determine the price. If we could find a reasonable benchmark, fine. We don't have to make exhaustive efforts to determine the price changes. Right? And as I said, if we have option X, we must try to find the similar instruments, similar equity instruments issued by the same company. Issuer here means ABC Incorporated, the company that has issued those warrants and options. So similar investment of the same issuer means same ABC Incorporated. Any other instrument, options and warrants that are similar to the investments we hold, we should take them as the benchmark. And any increase or decrease must be reported accordingly. Okay? Similar to equity investments. Okay, now let us just try to sum it up using a flow. Remember, this is as per the US GAAP. All right. Does the investment in equity securities result in control or significant influence? Let us take the highlighter that will point out exactly what we're doing. Remember what we are doing. Investment is between 1% or 0% to 20%. So if your investment is between 0 to 20%, you apply this fair value method. What do? Does the investment in equity securities result in control or significant influence? If yes, it means if your investments are greater than 20% and less than 50%, it means you exercise significant influence. In this case, you must apply equity method that we have discussed in 2.6, or you must apply fair value option. I will tell you later, just in this lecture. So if you have about 20 to 50%, it means significant influence. You must apply equity method or fair value option, right? If your investment is between 50% to 100%, it means you exercise control, then you must consolidate. That we will discuss in our topic 2.8. But if your investment is between 0 to 20%, it means you do not exercise control, you do not have significant influence, right? So if there is more than 20% investment, either you go for this or this. If it's between 0 and 20%, is the fair value of the investment in equity securities readily determinable? If it is readily determinable, just like the Gale Incorporated in the previous example we just did a little while earlier, if there is a determinable, readily available fair value, investment is measured at fair values. 100 fell to 90, went up to 115. That was the example we did a little while earlier. We must consider these changes in fair value as an incomes and losses in our income statement, right? If there is a readily determinable fair value. If there is no determinable fair value, why? Because the equity instruments are options or warrants that do not have the readily determinable fair value. So those investments, they do not have readily determinable fair values. So was the measurement alternative elected like the previous one we said? Yes. In this case, the investment is measured at cost minus impairment. Impairment have two steps. First the qualitative assessment, then the quantitative assessment, and plus minus any observable price changes of the identical or similar investments of the same issuer like the company ABC Incorporated we were discussing. That's the flow, how we do it in US GAAP, right? That's the point where we need to concentrate on. Is the fair value of the investment in equity securities readily determinable? In this case, we treat it like the Gale Incorporated. If no, was the remeasurement alternative elected? Yes, then you go for this. If no, then you may have to try to find the fair value. So the overall conclusion is that if we have a readily determinable fair value, only this could be applied. If no, if you have elected the alternative measurement, then you must follow this method. Cost, what you've paid, compare it with the impairment, and any price changes plus or minus, then give you the final value of your investment. Remember, this is as per US GAAP. US GAAP requires you to follow this method. Okay, now next, under the IFRS, this is the treatment under IFRS. Before we do that, we need to understand first what is fair value option, FVO. Because if you just remember, we did it a little while earlier. This one. Let us discuss it right here and there. This one. Fair value option. What is fair value option? Let's discuss this in detail. If your investment is between 20 to 50%, under the US GAAP, we apply fair value option. What is fair value option? Fair value option is selection made by the investor. Investor has the right to make a selection which method he would use to value his investment. If you have selected fair value option, your investment of $10,000, if they increase in value over the period to $12,000, this $2,000 gain, it is recorded in other comprehensive income. It is not a part of your net income. Remember, if you have elected the fair value option means any increase in the value of investment of the period or any decrease. Yes, there can be a decrease also. Maybe investment may have fallen to $9,300. In this case, there is a loss of $700. So under fair value option, if there is any gain or loss, that gain or loss is reported in other comprehensive income. This gain and loss is never reclassified in the profit and loss account. Even the investments are sold, right? And this fair value option is irrevocable. Once you elect this fair value option, there is no turning back. You can't change this method. Under the fair value method, fair value option, any gain and loss in the fair value of your investments, gain and loss are reported to other comprehensive income that we discussed in our previous lecture 1.4, right? So that's at the option of the investor. If he elects fair value option, there is no other way for him. Now, why we are doing this? Because we need it in our next treatment under the IFRS. IFRS has laid down similar flowchart. This is as per IFRS. IFRS says, does the investment in equity securities result in control or significant influence? Remember, control becomes exercisable if your investment is between 50% to 100%, and if your investment is between 20% to 50%, then you have these methods. So if it's between 50% to 100%, control means consolidation. If it's between 20% to 50%, it means significant influence, equity method that we discussed in 2.6. If you do not have control, you do not have significant influence, is the investment held for trading? Held for trading means you just buy those investments, you sell, you buy, you sell, you buy, you sell. If yes, if these investments are for trading purpose, then the investment is measured at the fair value through profit and loss account. If the investment was $10,000 and they've gone up to $12,000, it's a gain to be reported in income statement. If they've fallen to $9,300, there is a gain of $700 to be reported in profit and loss account. Right. So the gain or loss, if it is trading securities, must be reported as a part of profit and loss account. If this investment is not for trading, then the question is, was the fair value option through OCI selected at initial recognition? No. If you have not elected the fair value option, you must follow this method again. And if you have elected the fair value option, in that case, investment is measured at fair value through OCI. It means any holding gains and losses, they are put in the OCI and they are never reclassified, means they are never reported as a part of income. So that's how we treat investments that are between 0 to 20%. This is as per the IFRS. Remember, this is as per the IFRS treatment, and the previous one was as per the US GAAP. So that completes your topic 2.5, investment in equity securities.